it's been quite a performance year for tech, from Google to Facebook to just about every big name in the Silicon Valley. And next year could actually be better, according to our next guest. Bill Whyman of the ISI Group sees global tech revenue growing 7 to 8%. He joins us from Washington with more. So, Bill, is it the revenue that'll get better, or you think the stock performance will?
Well, if you get better revenue growth and specifically revenue acceleration, that almost always leads to better stocks for tech. And we didn't have that this year, but there were pockets of cloud computing names that did very well. But the problem for tech in 2010 was that revenue growth year over year peaked in the first quarter around 18%, and it's been decelerating ever since. And I think the big thing for 2011, for next year, is that we'll see revenue growth stabilize in the spring and then get modest acceleration in the second half. So 7%, maybe a few points higher for 2011.
Well, you know, reinvestment in equipment and buying of equipment seems to be pretty dependent on overall economic performance. I mean, is this business spending going to be the driver?
So I think you have a couple of drivers. You put your finger on the first one. Business spending has been okay, but they have a much stronger financial ability to spend in terms of cash, profits, balance sheet strength. They also have an additional reasons to spend. We just got a policy change where they can now write off 100% of the investment in the first year. And we also have new product cycles around the data center that I think will also incent businesses to spend. So I think business is going to be a big driver of it. On the consumer side, it's really emerging markets. Our analysis shows, you know, over half of PCs and almost 2/3 of handsets, the incremental growth is coming from emerging markets.
You know, the argument countering yours is that, you know, tech companies were hot because they had so much cash at a time of crisis. So there was sort of piling on of trades there. And I know, in looking at some research from Tobias Levkovich, who was on the program from Citi yesterday, who says that the industry group has the highest proportion of buy ratings by sell-side analysts of any S&P 500 industry groups. Basically, he says the only people who like tech are people who already own it, and it's too crowded.
Right. So I think I disagree with that. We downgraded tech a year ago, despite the cash, despite the valuations, because we saw slowing revenue growth. And tech has modestly underperformed this year, even with the cash. So I think the big difference between this year and last year is revenue growth. If we're right that we see revenue acceleration, then I think the stocks will respond. And the flip side is also true, that if we're wrong about revenue acceleration, then I think tech will have another challenging year. I don't think it'll be a bad year, but not the kind of upside that you'd certainly like to see.
Tech's a broad term. Where do you see the areas of strongest spending?
Right. So I think that's a key point. Beneath the averages, there's a really important shift going on. A lot of big cap tech underperformed this year. So the Microsofts, the Intels of the world. And there was a lot of outperformance around names associated with cloud computing. So Salesforce, VMware, NetApp, and also around all things mobile. Apple, obviously, the standard bearer there. And so for 2011, we'd be selectively adding to some of the big cap tech that got left behind. I think one of the names people should take a look at there is Oracle. It's what I call the best example of maturing enterprise tech done right. But I wouldn't give up on the secular growers. I want to hold them. I don't want to let them out, because I think to outperform in tech, you have to own the secular growers.